So welcome to this session of our training of our program, which is on mastering bank charges on bank accounts and transactions. As Radhela stated and as contained in our flyer here, the focus of this program is to give graduating accounting students, to give even step by extension, graduating taxation or tax students, graduating financial students who will be working in the practical world. So we want to create a nexus between the concepts, theories, frameworks they might have learned academically, no matter the professional touches that might have been brought into their education, there is still that gap between what happens in real life or in field or in the practicalities of corporate existence with whatever it is that must have been taught in class. So the purpose of this series is to create that bridge between our graduating accountants and financial professionals and tax professionals and the reality we have in the workplaces. So that is the concept behind this. And today we are taking on mastery bank charges on bank accounts and transactions. Ordinarily, most organizations that operate on large scale deploy the use of funding. These fundings could be theirs when it is equity financing. These fundings may be borrowed when we say an entity is geared. It could be a debt equity, it could be it could be a debt funding or equity funding. Those are the two structures. Funding owned by the owners or stakeholders of the business and produced by them, and funding provided by other party who are not owners of the business. So those borrowing, those funding, those resources taken to be paid back are debt funding. For most debt funding, for almost every single debt funding, there is interest or there is return payable on such borrowing. That is how we talk about interest on loan, interest on debenture, coupon rates on bonds, corporate bonds, as the case may be. Now, associated with borrowing, as I've just said, or as I've just stated, are the returns expected on such borrowing by the lender to the organization. Interest rate implication, other borrowing cost implication associated with having taken a fund. Therefore, an accountant working the first time or an accountant whose duty is to ensure the management of borrowing or financing is expected to be aware of the framework governing charges on all borrowings. Most of these borrowings, apart from when they are private, privately structured borrowing, right? Most of these borrowing come from financial institutions, whether they are banks or the fintechs that are extending their frontiers into lending. So generally, these borrowings come from financial institutions or financial related institutions. Therefore, an accountant whose role is charged with monitoring, with facilitating, or with even leading, or even structuring a borrowing, a debt, right? A funds drive, needs to be conversant with the framework governing how charges arise on these kind of transactions. That is the essence of this title, Mastering Bank Charges. These charges may be on the bank accounts that will house this borrowing or this funding, or it could just be those charges that arise or that are incidental to certain transactions. Hence this topic. A background. In Nigeria, we have a framework, we have a guideline issued by Central Bank of Nigeria. We have a framework, a guideline issued by Central Bank of Nigeria that prescribes, that guides the way charges should be made. It prescribes the acceptable type of charges between a bank and its customers, or between banking, other financial institutions, or other non-bank financial institutions and their clients. So that guideline prescribes the acceptable, there's a template, there's a profile of charges associated with borrowings that are instituted, that are legally obtainable in Nigeria, and the modus operandi and the mode of operations of running those charges. So we have that. Therefore, an accountant working for the first time, a graduate who finds him or herself, or a young accountant who has 2, 3 years of experience, of course, that far from being enough from certain kind of mastery. So an accountant, or even if you are a CFO for, even if you are a financial controller for years, but you've not been in charge of debt drive, funding drive, loan structuring, credit structuring, that professional, irrespective of the years of experience, may not have the requisite competencies to manage banking transactions concerning the associated charges, right? And other kind of fees that go with them. So that is the essence of the need of mastering the framework. So that framework, which I shall share shortly, just a second, I'm going to pull it up and then we have it. Okay, so let me go to the beginning. So this is the page. So we call, this is it. This is the circular issued by CBN. When a guide is given, CBN precedes it with a circular or a letter. It could be for the public, it could be for the banks or financial institutions themselves. So this is the, this is the prelude, right? The forward, so to speak, to the existing guide that we have in Nigeria. And this is the title. If I scroll down, this is the title. The title is The Guide to Charges by Banks, Other Financial and Non-Bank Financial Institutions. The Guide to Charges by Banks, Other Financial and Non-Bank Financial Institutions. So this guide stipulates all the charges associated with banking and financial transactions in Nigeria. It stipulates, like we say, a guide. It is not a rule per se, it's a guide. It creates a latitude of range of charges that exist in banking and financial transactions in Nigeria. Let's take note. Now, this was issued for the first time sometime in 2004. It was issued in 2004. Amended version issued in 2010, 2013, 2017. In that order, but the current one we use is that issued that became effective from January 1, 2020. I repeat, the effective guide to charges by banks and other financial and non-bank financial institutions is that became effective from January 1, 2020. And that is the version we are discussing here. So we are not discussing that of 2017, that of 2013, that of 2010, that of 2004. We are discussing the current one that is applicable. That's what you have before you. So I'm going to take us through briefly with the table of contents. We are not dealing with every single thing here, as we shall see shortly in the content. So I scroll straight. This document is available on CBN website and also available loosely on the internet. We may want to find that out. So these are the contents of the document. But our interest from this guide is on the interest rates, those charges associated with bank accounts or bank accounts and associated with transactions of financial nature. So as you can see, look at this document. There's a part 1 dealing with accountability and responsibility of a bank to report in a certain way or to maintain certain risk management and credit framework. Part 2 deal with banks. Those fees and transactional charges associated with banks as a whole, that is part 2. Part 2 will have the part 2 that deals with banks. When you scroll down, you see the part 2 that deals with other financial institutions. Now, there is a part 2A because under OFIs, we call them OFIs. In fact, there is a directorate in charge of other financial institutions in Nigeria under the CBN, right? So we have the aspect of this guideline that deals with transactions and charges from by microfinance banks. That is what you can see on the screen as section part 2A, microfinance banks, right? So as I move on, I go to part 2B down the line. There's a part 2B down the line. So in part 2, you'll see part 2B, which is a primary mortgage banks. The one we also call primary, mortgage institution. That's what we can see here, primary mortgage banks. So apart from your typical microfinance banks, for example, we have mortgage institutions on their own. right? Now, they are lending, their charges. So there's a section of the guideline that also deals with that. That is part 2B. Now, if you scroll down in the document, you're going to see part 2C. Part 2C. Now, part 2C deals with finance companies. Part 2C deals with finance companies, right? These are your discount houses and other associated kind of institution. Now, there's a part 3 of the document. There's a part 3 of this document. This part 3 deals with what? Mobile money operators. All of the fintechs, right? All of the fintechs that you know. Let's say the Momo agent, for example. Let's talk about the Money Point, for example. The OPay, PalmPay, and the rest of them. They come under money. They come under mobile money operators. So for those transactions, how are they charged? They are there. So part 2 of the document contains a glossary of definition of issues, of words, right? Terminologies used. Now, part 5 of the document talks about minimum disclosure requirements in offer letters of credit. In offer letters for credit facilities and for loan. When a loan is given by a financial institution, when an advance is given, a credit is created, a letter is often written documenting the terms and conditions covering that credit facility or covering the loan. So there are minimal disclosure requirements expected from a financial institution. Everything should be there. So I've just taken a stroll about the components of this guide to charges by banks and other financial institutions. So as I said, this is the heading. A second, this one is the covering notes. So as I was saying, now this is the heading. Okay, yeah, this is the heading. This is the heading on the document we're talking about. So it contains all of those parts, but our focus here is on those ones that are charges, right? So we are going to pick them for charges associated with commercial banks, commercial banks. We are going to pick those associated with microfinance banks and those associated with what? Primary mortgage banks themselves. So we are going to be going to the pages of the document to pick them one after the other. Then starting with out of the banks, so this is the content, right? So under banks, if you follow me, if you look at what I have on the screen, you are going to see interest rate section 2, this is interest rates and lending. That's what we have under section 2, interest rates and lending fees under banks. When I scroll down under microfinance bank, you see interest rates and lending fee, also under section 2 of part 2A. Interest rates, interest rates and lending fees. When I go to primary mortgage banks, or the one we also call primary mortgage institutions, and bank is one of them, you have the interest rates and lending fee. So as a graduating accountant, or as an accountant with limited years of experience, or even an accountant with many years of experience, but who does not have experience in this area, right? That makes you novel too. That makes the concept move as well. So these are the areas we are going to be looking at. Interest rates and lending fees for transaction with banks, transaction with microfinance banks. When I said bank, I meant the commercial, both regional, national, and international bank, right? So microfinance banks, secondly. Thirdly, the mortgage banks. We need to have an idea of this nature. So let's take note of the pages we're going to be looking at from here. When you look at the interest rates, right, and lending fee for banks, you see that is on page 8. Let's take note, page 8. Then the one for microfinance bank is on page 30. Page 30. Then if we scroll down and go to the mortgage bank, that's on page 44. So those are the places we'll be going to discuss every single thing concerning these charges and what applies. So I use the paging number to move straight down to page 8. Let's discuss the one that has to do with banks themselves. Let's discuss the one that has to do with the banks themselves proper. Okay, so let me take it off from here. the document itself, the way it is provided. So let me make it more order. Okay, so this is it. So let me drag this down so that we can see section 2 here, interest rates. Can someone confirm to me that they can see the screen I'm sharing? Can someone confirm the screen that is on? Can we see the title, section 2, interest rates and lending fees? I need someone to unmute and speak, or just use the chat button.
Yes, sir. You can see it, sir.
Okay, thank you very much. Thank you so much. So now let's start. When a bank gives a loan, of course, there are two kinds of loan, right? We could have a loan denominated in a naira. We could have a loan denominated in foreign currency. So whether a loan is in dollars, whether a loan is in pound sterling, whether a loan is in euro or in any other currency, those are foreign currency denominated loans. We could have our local currency loans, which are loans denominated in the naira. Now, in another session, right, we'll be maybe in the future, we'll be dealing with those one that have to deal with those foreign currency denominated loans, which are used for international trade. Our time will not permit us to do justice to all of the technicalities and the operationalities of those concepts. So on interest rates and lending fees, this section, we are focusing on banks. And we'll start with the local currency loans, right? Now, what is the pricing under the interest rates? How should it be priced? How should it be priced? So I read, please follow me. It states that for local currency loan, how do you price the interest rate? When a bank tells you 40%, 20%, 30%, how is it arrived at? What is the basis for that pricing? So look at what the guide says. The interest rate is negotiable. Negotiable, highlighted, negotiable. Now in bracket, the rate to anchor MPR. MPR is the monetary policy rate. Monetary policy rate. Please, when you hear that there is an MPC, Monetary Policy Committee holding in Q1, in Q2, Q3, Q4, it is important to pay attention. Is there a case of will you come out in my ICANN exam? Is it in my ANAN exam? It does not, ACCA does not have a question on that. You see, passing examination is different from functioning in a real world. And more importantly, totally different from functioning competently as a premium professional in a dog-eat-dog world. So then after you pass the exam, you can cram, what is there? You cram past questions, do all of those, and you pass. Now you get the job, can you do the job? You begin to, to drag your feet when you shouldn't. So please, when we hear that the Monetary Policy Committee, is meeting, the CBN governor, the deputy governor, and all the MDs of commercial banks in Nigeria, when we hear that they are meeting, we should pay attention. What is going to be the monetary policy rate for that quarter? What is going to be the outlook? What is going to be the outcome? Why? Because interest rates take their bearing from the rates quoted as the monetary policy rates. In other words, the monetary policy rate gives the foundational line or the baseline upon which a bank prices its loan. Right? Yes, upon which a bank. Now, let us just say the monetary policy rate or the prime lending rate is 18%. That becomes the baseline. So a bank is going to lend at any rate above 18%. Rates could be doing between 20-something%, 30%. They take bearing from what the monetary policy rate is. And that was one of the richest men in the world, we the Nigerian, complain about the monetary policy rate. They're going to make loans, taking of loan, expensive. Government want to encourage people to deposit their money and not to take loan to fight inflation and all of that. So the point is, interest rate primarily is a function of the monetary policy rate plus other operational costs of the lender. A bank has costs it incurs, staff costs, security, power, stationery, you know, it has a target return it wants to pay its shareholders. All of these things are the elements that are added on the MPR, another prime baseline of rates, to determine the lending rate to they give to a customer. Therefore, the guideline cannot specify, of course, what the interest rate will be. So the guideline cannot specify what the interest rate will be. No. What the guideline can do is to give those base. That is what the guideline states. The interest rate on local currency loans are negotiable. The rate to anchor monetary policy rate reflecting the risk-based pricing model. You know, when interest rates are quoted, you see, the riskiness of the purpose of a lending, or the riskiness or credit riskiness associated with a borrower defines the premium or the interest rate charged on the loan given to that potential borrower. I repeat, the riskiness of the purpose for which a loan is put, or for the purpose for which a loan is given to someone in the sector, or concerning the credit risk of the potential borrower that will call the obligor. That riskiness defines the interest rates charged by the lender. That will call risk-based pricing model. So the guy goes further to state, when the bank intends to introduce a new rate different from the agreed rate, the bank should notify its customers of the new rate at least 10 business days in advance of the application of the new rate. Let's assume you work in a company that has a loan that is running, and the CBN revises the monetary policy rate that necessitates that the lender or the bank that had given that loan to your employer increasing the rate. The bank cannot just unilaterally or immediately increase the rate without communicating. The guidelines state that the bank must write the customer for an interval or for a period, a window of at least 10 days. You must give a 10-day business day notice. Business day, not your typical calendar day notice, no. So today is July 6th. Today is Saturday, right? Let's take yesterday, for example, that the MPC held a meeting yesterday. The rates they rolled out necessitated that the bank should increase the interest rate on existing loan. Yesterday was Friday. 10 business day period will start from the coming Monday to Friday. That is 5 days. Then another Monday to Friday. Saturday and Sunday are not inclusive. So that is the period of time a lender is required to advise an obligor and a borrower on the plan to revise its interest rates. So that is that on interest rate. It is defined, it is negotiable. A customer or an entity with the bank agree, they reach a compromise. The bank says, I'm charging you this, or this is my rate, this is my rate. And the rate being advised by the bank must have been informed by what the monetary policy rate is at the time. Another prime lending consideration. That is on one hand. When there's a need for a change of interest rate on an existing loan, the bank needs to write the customer on the need to review the rate, and that notice must be for a minimum 10 business days. 10 business days in advance of the application of the new rate. Therefore, if you work in a company or an accountant in an entity that suffered sporadic change of interest on an existing loan, you need to write to them, right? Bring attention to the existing guide to charges by banks that, please, this is the minimum period of time for which notice to be served before any interest rate is reviewed. So that is key. So that is the interest rate on local currency loans. What about mortgage financing? When you go to take a mortgage financing, of course, the rate is negotiable, so interest rate negotiable. Interest rate on foreign currency loan also negotiable, right? Now, interest rate on authorized OD. OD means overdraft, also negotiable. Negotiable. Anything interest rate is negotiable generally. That we know. Now, I'm going for unauthorized OD. Unauthorized OD or credit, unauthorized overdraft. I'm going to speak more on it later on. But generally, what is the meaning of unauthorized overdraft? What is the meaning of unauthorized overdraft? A bank can give another overdraft to a customer. That overdraft means authorizing a customer to withdraw an amount above the balance that customer has in the bank. Overdraft is a financial contract entered into between a bank and its customer that allows the customer to withdraw or access an amount more than the balance of that customer in the bank. So if a customer does not has a 1 million naira in his account, and the customer writes and gets an approval for an overdraft of 2 million, take note, the customer has 1 million in the account, and an OD, an overdraft of 2 million has been given. Therefore, the customer can withdraw 3 million. 3 million. The 1 million in his account ordinarily that belongs to the customer, plus the 2 million naira overdraft facility that has been granted. That is an overdraft. So that is the structure. And that is when it is authorized, meaning there's a formal process that enables such access to fund or money beyond the balance in the account. When is it or when it is unauthorized? Whenever a bank, either by way, ordinarily, you cannot withdraw, you cannot write a check for an amount more than what you have in a bank. The bank is going to dishonor the check, right? They're going to dishonor the check on the ground of insufficient fund, or simply saying that, okay, drawer's attention required, DAR, for example. However, there are ways through which customers overdraw their accounts. Maybe a customer has swept or withdrawn the total money on his account, and they are pending debits. Those pending debits may be VAT, certain commission charges, VAT on those commission charges, and even account maintenance fee, for example, including your SMS alert charges that the bank sends to you. Recall, the customer pays because the customer accounts are debited. So for things like commission on transaction that is still floating, that has not dropped into the account, VAT on that commission on transaction, SMS charges, account maintenance fee, and VAT associated with all of these. Now, these kind of debits sometimes are hanging. In other words, while a customer might have withdrawn his or her money, or when an entity might have exhausted its balance in an account, these items we've mentioned may be hanging or floating. At the end of the month, what happens? They drop into the account. When it drops into the account, because there's no fund in that account, the account goes into a debit balance. The account goes into a debit balance to the tune of the amount of these charges that are not funded. That is how unauthorized overdraft arises. Why? A customer has withdrawn all of his or her money, or the entity has withdrawn its money, and does not have fund to pay for the charges associated with those withdrawals or with the running of transactions on that account. So when you see an account with such debits, it is an unauthorized overdraft. So it's a credit facility that has been given, but it's unauthorized. So under our banking laws, under our banking guidelines and regulations in Nigeria, of course, unauthorized overdrafts is not allowed. So the issue as to what is the interest rate on unauthorized overdrafts, there is no interest rate. Why? Because unauthorized overdraft is not permissible or is not permitted in the first place. But we know, we know they do arise, those debits, those over, in quotes, over debits or accounts swinging into debit balances. We know credit amount whatsoever available to clean out that debit. We know they arise. So because they do arise, under those circumstances, they're unauthorized, interest rate does not apply, but penal rates may apply. Penal rate is the rate charged by a customer, by a bank on a customer for violating the terms and conditions of a facility. So ordinarily, when your account is in debit balance and you do not know, right, and you didn't take any loan, you won't express penal rate ordinarily. But when you are taking a loan that contains one of the terms requiring you to pay an amount of money at the end of every month, if at the end of the month, there's no money in your account, for example, your account is forced into debit. You know, when a loan is given, there are monthly repayment templates that stipulate amount that would be debited to account every month. So whether your account is funded or not, your account will be debited. That is another major cause of unauthorized overdraft. You've taken a car loan, month 1 you've paid, month 2 they were debiting you because your account was funded, month 3 there's no money in your account. That debit will still drop. Why? It is system automated. That debit from month 3, it will drop. When it drops, and without the account being funded, your account is going to remain in debit. So that is another major form of unauthorized overdraft, as against those other charges I've mentioned before now. Because what more banks do, even if you check your account, you are going to see pending debit. I don't know, when you look at the notifications from your email or when you log on to your app for your bank account, where there are SMS charges, where there are commission or maybe letter of reference, where there are SMS alerts, where there are account maintenance fee that are to be debited in your account. When you watch your account closely, you are going to note them, you are going to see them as pending debits. Most banks do that. As pending debits, that means they've been removed from the balance, from your amount, from the amount of money in your account. They've been removed, but they've not been dropped as effective debit into the account. They are floating, right? Those are pending debits. So at the end of the month, when a bank cleans his account and does a month-end reporting, all of those pending debits drop. So that is the approach banks have devised to ensure your accounts are not first debited as a result of not having funds to foot your SMS charges, not having funds to foot account maintenance fee, not having funds to foot your the VAT associated with these transactions. So the bank take these charges up front, right? But they are pending until the end of the month because they are cycle related, right? Apart from SMS alerts, right? Because they are cycle related, when these debits drop at the end of the month, right, the bank does not need to bother anymore whether you have money there or not because they're taking them ahead as spending debits. So that's how bank deals with that. But when it comes to loans given that are required to be paid back instrumentally, and a customer or an entity does not have any fund in his or her or its account, that account is still debited because the periodic payment is automated. So when the account is not funded and the debits drop, the account goes automatically into unauthorized overdrafts. So what the guideline says, for such facility, go and check for all loans given by a bank, there's always a penal rate. Penal rate means when you fail to pay your periodic, your required instrumental, there is an interest rate that is charged. It may be 1% flat. For example, 1% flat meaning 1% of that amount you have failed to pay. If your installment is 100,000 naira and you fail to pay, so 1% of 100,000 naira is going to give you 1,000 naira. That is the penal rate expense incur by allowing your account to go into unauthorized overdraft. That is how that works. Now, all of these items we mentioned are on the interest rate. Mortgage loan, foreign currency loan, local currency loan, authorized overdraft. How is the interest rate calculated? That's what we are saying. Negotiable. When we go to the OD, the overdraft that is not authorized, negotiability does not come in because it's not authorized in the first place. It's an infraction in the first place. So there's no negotiability, not at all. However, we know that there could be an unauthorized OD based on the second example I just gave. The periodic payment that are dropped into an account by the system, irrespective of whether an account is funded or not. So for such unauthorized OD, there is no interest rate because it's not negotiable, right? It's not permissible. It does not even arise at all. So negotiability does not exist because the transaction of unauthorized OD does not exist under our banking regulations. Therefore, for those unauthorized ODs that do drop, that do materialize or arise as a result of false debits created by the software that is trying to claim periodic repayment, so they suffer penal rates, which are often flat rates. So I don't want to clarify that those penal rates are not interest rates. That is why I'm trying to repeat that. Now we go to another transaction, drawing against uncleared effects. What does that mean? For those of you who do not have banking experience yet, or are not used to, the kind of the mannerism, right, or the operations in the bank, when we say uncleared effect, this is it. Another party has given your entity a check, and the entity has lodged in that check. And that check, it doesn't clear immediately, right? It doesn't clear immediately. When the check is lodging today, currently in Nigeria, when the check is lodging today in Nigeria, now it's going to get value in the 12th midnight of the following day. 12th midnight. If a check is lodging on a Monday, for example, you are going to get value on the cutoff time between Tuesday and Wednesday. That is when that check gets value, meaning that is when the recipient of the lodgement or the entity for whose interest the check has been lodged can now draw down on that money. So if today is Monday and the check is paid in, and the check going through clearing, a check of another bank issued to an entity that has an account with another bank. Let's say Zenith Bank check issued to an entity that has an account with Providence Bank. A Zenith Bank check paid into Providence Bank on a Monday. That entity cannot go to Providence Bank to withdraw that money on a Monday. It cannot. It has to wait for Tuesday to withdraw the money. It has to wait for Tuesday to withdraw the money. Therefore, after that Monday, that entity can approach his bank that, hey, I have a check in clearing. And that check is from a credit-worthy customer. Maybe like one of the multinationals, for example, or one of the key federal government agencies, or key government agencies. Their checks do not bounce ordinarily. So that entity can meet the bank. See, I have a check in clearing for 20 million. Can I access 10 million? So that when it clears the following day, you net off the advance or credit you are giving me. So that will call drawing against uncleared effects. So for the amount that is to be availed or made available under that circumstance, the lender or the bank charges you interest rates for that amount you want to access ahead of the time when your check will have cleared for you to have, unconditional access. So the interest rate for that portion to be advanced, right, out of the total value you have on that check in clearing or those checks in clearing, the interest rate is negotiable. That is what the guideline is saying. Equipment leasing. Leasing is a kind of loan, but it's a loan for which there is a specified underlying assets. You can take a loan to buy a motor vehicle, to construct, to hire a machinery, or to hire a plant, right? That is, so when there's an underlying asset, like a motor vehicle, a plant, a machinery, or a special equipment that is meant for use for a certain period, leasing comes. So the leasing could be structured in different way, right? But when we talk about equipment leasing, this is a finance leasing or capital leasing. The purpose, the leasing here is not about the operating lease. The leasing here is about finance lease. When the customer that has gone to the bank intends to own that asset, not to use and return, like in an operating lease. The borrower intends to own the asset. So why you call it leasing? Because there's an underlying non-current asset to be financed. It is typically a loan. It's just a loan. But it's not a loan backed by a specified non-current assets. So it's a loan. So the interest rate on that kind of equipment leasing is also negotiable. That is what the guideline says on that. Let's take note. Now, we have what we call discountable instruments. For this one, I won't say much here, right? Maybe when we meet in another session, we deal with what is a banker's acceptance, commercial papers, usance bill, or usance letter of credit and all of that. But this is a summary. All of these are financial instruments for which there's a pricing, there's an interest rate paid. So wherever the financial instruments are, the interest rate there is negotiable. So we are here in this section dealing with the determination of the charges that arise as a result of interest rates. How is interest rate priced? Or how are interest rates determined? In summary, they are negotiable. And for most of them, like we've seen, the baseline is the monetary policy rate, which is why I said, let's learn to listen out to those quarterly or periodic meeting of the Monetary Policy Committee or the Central Bank of Nigeria when they meet to review the impact of the existing rate on the economy, to know whether to add or to deduct from the basis point of pricing. Let's take note. That is right on interest rates. We'll go to penal rate. Penal rate. I've explained this before because I know we are going to meet it here. Penal rate is a punitive rate charged on a customer for default on the terms and conditions governing a repayment. Penal rate, right, is a punitive rate charged by a bank to a borrower for default in the terms and conditions on the repayment of a facility or of a loan. That is a penalty, a penal rate. That is what it is. So look at what the documents say. In the word of the document, it states, penal rate is in respect of past due loan and advances, including excess over authorized OD or credit limit, right? So when a loan repayment is due and unpaid, that repayment on a loan may be payment of the interest on that loan, may be payment of the principal on that loan, or maybe both payment of interest and principal, because each installment ordinarily contains a payback of the principal and a payback of the interest on the portion of the principal consumed. Two components make up the interest, the instrumental, right? Now, failure to pay for this installment as the full due, we say that the loan or advances is now past due. When we use the word past due, we mean a loan or advances has suffered non-payment of accrued associated interest or principal portion of the entire loan. So when it has not been paid in line with the timeline, in line with the specified date, we say that that facility is past due. So for that portion that is past due, or that is due for payment, for which payment has not been made, a bank can charge you penal rate. So what is the rate? Look at what the guidelines say. For Naira loans and advances, please, may you take note of here, highlighted. For Naira loans and advances, maximum of 1% flat per month of unpaid amount, in addition to charging current rate of interest on outstanding debts, without prejudice to the provisions of the Prudential Guidelines on the limitation of accruals. I repeat, for Naira loans and advances, the maximum penal rate is what? 1% flat per month of unpaid amount, in addition to charging current rate of interest on outstanding debts, without prejudice to the provisions of the Prudential Guidelines on the limitations of accrual. Now, let me explain. If on a monthly basis, your company is to pay back 1 million Naira for a 6-month term loan, for example, 1 million Naira every month. Now, at the end of month 2, your company fails to pay 1 million Naira. Now, that 1 million Naira is installment because an interest rate plan will have been communicated to you. At this point, permit me to quickly share a repayment template. Let me share a repayment template quickly. Now, if you look at the screen now, everyone, if you look at the screen, yes, you can see a simple loan calculator. Let me impute that up. Now, look at what we have here on the screen. Let's say your entity took a dollar line. So let me come down. So say the dollar line is, say $10 million. Look at the screen, please. You're going to say $10 million, right? Now, annual interest rate, currently, let's say 35%. Let's be, that is, 35% and above. Now, loan tenor, let's say 4 years. No, let's say 2 years. 2 years. 2 years. Loan start date. Let's say this loan started sometime in, okay, let's even say today. No problem, today. July 6th. 6/07/2024, for example. Now, look at this column, everyone. Look at this column, everyone. Look at this column. I want to highlight a column here. A second. that, look at, I'm highlighting column F. Column F. Column F is the instrumental payment. Column F is the instrumental payment. And the amount in the column F here is, it creates a case of simple annuity, right? Simple annuity, ordinary annuity. The amount here is what? 585,000 every month. Now, let's now assume that after month 1, your company paid. After month 2, your company defaulted in paying. After month 2, your company defaulted in paying. Take note and recall, this instrumental payment, as we said, contains your principal. Look at this column, principal interest. It contains the relevant portion of the principal and interest. The addition of this principal of $302,000 plus $283,000 gives you $585,000. That is instrumental payback. Now, if you're anything first to pay in month 2, what is penal rate? Penal rate is 1% times, look at what the guidelines say. The guidelines say a maximum of 1%. 1% of 585,186.19 cents will give you the penal rate. It would give you the penalty paid for default. 1% is the penal rate. 1% times this. You don't say 1% times this times so days over 1. No. When we say flat in finance, when we say a rate is priced flat, just use that rate, multiply the principal amount. What you get is the amount required. That's why we do a flat pricing. But when we're putting it in a cycle, that's what we say per annum, per quarter, every 6 months. We are assigning it to a cycle. That is when you proportionalize. Say 1/100 times this, times 365 days, or 1/100 times this, times 90 out of 364 days, and all of that. You are proportionalizing. But when we say an interest rate or a rate is flat, you don't proportionalize. It is that interest rate times what you have here. In this case, we'll say 1%, right? Times this will give us something. That will give us $5,851.86. That's what we have here. Approximately $5,852. So that is the penalty arrived at using the penal rate for each month. What happened in month 2? The customer still has not paid it. The customer still has not paid it. You take the 1% again, multiply on that amount that is due for another month. You don't say, okay, no. You see, you don't compound. You don't compound penal rates. Please stay with me on this. You do not compound penal rates. This is the installment for which I have defaulted. 1% times this will give me the amount I'm owing. For the next month, I default again. 1% of this amount will give me the amount 1. Then 1% plus the amount I'm owing before will give you another amount. For penal rates, we do not compound penal rates. They keep accumulating in that form. So that is a demonstration of how penal rate is done. Please, someone that is striking, a writing across should stop, please. I don't need to clear and reshare, please. Please, let's mind the document, please. Let's mind the document. So we move on. Now, take note. Let me explain this briefly. It is not our focus, prudential guidelines. In Nigeria, we have a guideline that stipulates how an entity makes a provision for a loan that is past due. I've explained what past due means. For a loan, for repayment of principal or interest, or payment of principal and interest is past due. We have a guideline that stipulates how an entity, how a bank should make a provisioning. What we call a provision for doubtful debt in accounting, right? We call it impairment in IFRS. In Nigeria, we have a guideline that stipulates how you calculate impairment under our prudential guideline, right? So there are different rates. What this guideline is saying, that when you are charging penal rates, continue to charge your interest rate accordingly on the principal amount outstanding. That you are charging penal rate does not mean you will not continue. You are going to continue to charge your interest rate on the principal amount outstanding. at each point in time. You know, I'd said, take notes, you know, I've said that we don't compound penalty. We don't compound penalty. 1% and that outstanding installment will give you the amount of penalty financially payable. Now, the portion of the installment that has not been paid, we attract interest rates at the existing interest rate itself. What am I saying? You have a 2 million naira unpaid, you are owing 500,000. So the interest rate will be used to multiply the 2 million that are ordinarily owing, for which there is no default, one. The same interest rate will be used to also multiply the 500,000 that you have not paid, because you've also taken another further loan. By not paying a loan or a portion of a loan when it is due, it means you are still holding on to credit. That is the meaning. That is the meaning. So on the ordinary amount that is running, one, for that cycle of interest calculation, that is one. Two, the interest rate is also used to multiply the portion of the loan due for which you have not paid, because you are still using that credit. But penal rate is limited to only the portion unpaid on a month-by-month basis. So the standard say, as a standard, the guideline rather say, you know, maximum of 1% flat per month of unpaid amount. That is how it is done. Therefore, a bank cannot charge you 1.2%. They cannot charge you anything beyond 1%, but you can negotiate, they can charge you below. And that will be, will even have been contained in your offer letter. We go to the next one, foreign currency loan and advances. Where there are dollar lines, where there are dollar facility, that are import finance facility, or where there are euro or any other foreign currency line, the penal rate is what? 0.25% flat. That's the maximum. It can be 0.1, it can be 0.01, it can be 0.00008, whatsoever percent. But the maximum, the cap is what? 0.25% as the penal rate. All other explanations given for Naira loan apply. That is on interest rates. Now look at what we've dealt with so far. We've dealt with 2.1 that dealt with interest rate generally, and then the penal rate associated with the default. Now we now go ahead. Lending fees. You see, when a bank processes a loan or processes transactions, you see, the bank is a business. You are charged some set of fees. Therefore, what are those fees? Legal, allowable under Nigerian banking regulation. For someone that is a head of account, for someone that's an accountant, for someone that's an account officer or an accounting officer in charge of financial banking transactions. What are those fees your employer or your entity can be charged when they go out to seek a loan? Those are things we refer to as lending fees. These fees are different from the interest rate I've explained. These are about the fees. So let's start number one. There is a management fee. That what we call management fee. Management fee, right? Now, the management fee, take note, the guideline stipulates that the maximum rate to be charged as management fee is what? 1% of the principal amount disbursed. Maximum is 1%. In other words, management fee can be 0.5%, it can be 0.75%, it can be 0.99%, it can be 0.2%, it can be 0.1%, it can be whatever, but not more than 1% of the principal amount disbursed. Let's take note. That amount of credit actually given to you by the bank, that amount of credit given to you by the bank is the principal amount disbursed. 1% of it is management fee. And our guideline, our current guideline, take note, you see, there have been changes in this guideline. We are talking about the current and existing guideline, right? That became effect, that came into being in 2020, January 1. Let's take note. So take note, the guideline says one-off charge is a once and for all. Is a once and for all. Now let's take the notes under the document. Read another one. It says 7 days grace period shall be allowed before penal charge shall be applied on account. For the avoidance of doubt, there is no forbearance or penal charge for the duration of the grace period. Okay, that was on penal charge. Number 5, amendment fee rather. Let me read amendment. It says, Management fee is chargeable for all fresh requests and renewal of expired facilities. No charges for requests declined. So management fee is for the disbursement of a loan, any fresh loan requested, a facility might have expired, right? That facility may be renewed. Probably there have been cases of serious default, it has expired, or there's a need for renewal. Management fee is chargeable on renewal of expired facility. Right? What do you mean by this renewal of expired facility? Your loan is to run for 2 years. After 2 years, you've not paid up the loan. You're not going to loan restructuring. That please, can you help me break it down? Can you extend it for another 36 months? Can you do this for me? Can you do that for me? And when the loan is a renewed loan, a renewed facility, that renewed facility is also subject to management fee. Let's take note. But all time, management fee is once in a lifetime. And the primary disbursement of the principal amount one, renewal of a spare facility, let's take note, right? An addition of new loan into the existing loan, we charge management fee. If you are the bank,
Hello, sir.
we are charging management fee if you are the company. Yes, Hope, please.
Yes. Good afternoon.
Yes, afternoon.
Sorry, I joined late because I was trying to log in and it was not coming up. I discovered the ID have changed. I later went on the flyer to check that the ID, the former ID we use is a different one. So we talk about management fee. Is it advisable you pay the first time you pay with the interest? Is there any stipulated law that it is a must that the first month you pay the interest, you pay management fee, or you can hold on to the last payment?
Okay, the way management fee works, management fee is paid immediately. As the loan is disbursed, you are debited for management fee. It is not subject to time. It covers all the processing, appraisal, all those other run around incurred by the bank while trying to get the loan on for you. So it is not paid at the end of the month, it's paid upfront immediately. As the bank is crediting you with 1 million, for example, 1% of 1 million is debited to your account straight up.
Okay, that means that because they will take part of the management fee from it.
Yeah, it is from the loan that they take management fee. Some bank will tell you fund your account, right? Because they're going to debit it for the management fee. Whether you fund it or not, they're going to debit you to the tune of 1% maximum for that loan that they've given you. Where you have funded your account, you get the entire 1 million to spend, for example. When you did not fund your account at all, your 1 million will be less the management fee that the bank has charged. That is the way it works. It does not wait till 24 hours or 2 days later. No way. It's immediate, so long as there's a disbursement. So that's the way it works. So that is not the management fee, and the cap is 1%. Let's take note. We move on to other facility enhancement fee. You see, you might have asked for 2 million naira before. Later on, you now come to the bank, please, that 2 million. No, can you just make it, can you give an additional 1.5? Just, can you make it 1.5? Let everything be 2.5. So what are you requesting? You are requesting for facility enhancement. Do you get? So yeah, so we say this year applies when an additional amount is granted to a customer. You're enhancing your facility. The fee we charge is called facility enhancement fee. Right? That's what we charge in place for what you should have been charged along as management fee. We call it facility enhancement fee, and the max is also 1%. It's negotiable, but the cap is what 1%. It can be low, and it is also one of also. Now we go to restructuring fee. Restructuring fee. What is restructuring of a loan? Restructuring is the repackaging of a loan as a result of conditions necessary to prevent defaults or continuing defaults on a loan. So restructuring is the repackaging or the reworking of a loan to avoid or to stop circumstances that will cause default on that loan, or that will prevent continuation of default of that loan. So when we say we are restructuring a loan will be given to you. We say you'll be paying 2 million every month. Now all of a sudden, you are struggling. Today you pay 1.9. Tomorrow you pay the 2 million. And that month 1.3. The only thing is, so we are not looking at the cash flow. Hey, your cash flow is not supporting convenient paying back of this installment. Therefore, we may need to restructure the loan. When we restructure it, we may do it in such a way that, you know what, let's give this customer a longer period of time so that the periodic repayment will be low, so as to enable the turnover that comes in to fund that periodic repayment. That will call restructuring. Restructuring can also occur for a loan that was going on fine, and still going on fine. But the market condition, the market segment, from where the customer is making money to service the loan, things have changed. In Pidgin, we say things don't change, right? Rather than the customer defaulting, the customer can request, please, can you please restructure this loan? Based on the credit risk drivers that customer is seeing in this marketplace, based on his own credit risk. So a loan can be restructured. 2-year loan can be extended to 3-year loan. 7-year loan can be extended to 15-year loan, for example. The interest rate may be reduced. The interest rate may be increased. There may be waiver. There may be cleaning up and all of that. To return. Under IFRS, we say loan modification. That's what we call it under IFRS 9. Credit or loan modification. You modify it to suit the new request or the new reality on ground. Therefore, there are what we call restructuring fee. This restructuring fee goes with restructuring. But there are two kinds of restructuring. A bank may choose for certain reason to restructure a loan. 1. 2, a restructuring may be at the demand of the customer. Please, I can't cope, restructure this loan for us. So when a customer instructs or necessitates the restructuring of a loan, we call it restructuring at the instance of the customer. It is the customer that is making the demand for restructuring, and there's a fee. So the guidelines say the maximum fee chargeable is what? 0.5% of the outstanding amount being restructured. Take note of the caveat of the outstanding amount being restructured. For a 10 million naira loan, for which 8 million has been paid, and the customer approaches the bank to restructure the 2 million outstanding, the 0.5%, for instance, if that is the rates agreed, is not based on the 10 million. It is not based on the 8 million that has been paid. It is based on the 2 million naira outstanding that necessitates a restructuring. Let's take note. The percentage you are seeing here is the cap. It could be lower. Let's take note. That is that on fees in that area. Then it states the management fee does not apply to the restructuring facility. That we don't charge two kind of fee on the same underlying transaction. Management fee, one-off. Facility enhancement fee for additional amount, one-off. You don't go back and charge management fee on it again. And also restructuring fee, one-off. You don't go back and charge management fee on it, not at all. These are one-off charges. Now we have what we call commitment fee. Commitment fee, everyone. Commitment fee, let me explain. Commitment fee is the fee charged to extract commitment of a borrower, of a potential borrower, or a potential obligor to a lending transaction. When you say you want to take a loan, you need to give us a commitment that you are for real. You need it for the substance of the transaction. So that is what commitment fee is about. And the guidelines say it is subject to a maximum of 1% of the undisbursed amount. Undisbursed amount, right? When we say I'm going to pay, commitment fee, 1% of the undisbursed amount. So this is demonstrating that you're actually pursuing a loan, or you're pursuing a credit availability, a credit facility that is available to you as an entity. So the cap is 1%. Let's take note of this rate. And we need to know them offhand, because this is our industry, financial industry, finances. So we need to know. If you check generally, all of them are 1% as cap, except for restructuring fee. If you have to play it back, you know that all of them are 1%. Management fee, facility enhancement fee, and then 1%, except for restructuring, which is a hand for feet, 0.5% as cap. Let's take note. So these are the things that are associated. Now we go to charges for consortium lending. What is consortium lending? Consortium lending, when two or more financial institutions come together to package a loan for a customer. When two or more financial institutions, two or more banks come together to package a loan, we say it's a consortium lending. Right? Now there's an agency fee. You see, there is an agent that is the enabler of that consortium. There's an enabler or something that looks like a syndication coming together. There's an agency in charge, there's a party in charge that does the coordination. So agency fee applies. What is the rate? What is the percentage? You see, in finance, charges are based on the amount you want to collect or the amount you want to give. That is the underlying reason for all financial dealing with respect to borrowing and lending. So any percentage you are quoting is either on the total amount, is either on the portion unpaid, or the portion that has default arising on it. It must be from the amount, not from any other thing. Not 1% of your building, not 1% of your shoe. No, not at all. There's a primary item, which is the amount to be lent, or a portion thereof, the principal outstanding, or the interest outstanding, or a combination in these other forms. So for a loan syndication of a consortium of lenders coming together, someone is we call them transaction arranger. Transaction arranger. That is a term we use to describe it. Transaction arranger or transaction facilitator. So there's an agency fee that is paid to that person or to that company or to that party. So the rate is negotiable. That's what the guidelines say. Now, management fee for such is as before, 1% cap, and it's one-off, 1% of principal amount. Commitment fee, right, is 0.5% of the undisbursed amount. 0.5%. Take note, this 0.5% differs from the commitment fee of 1% for an entity-specific kind of lending or borrowing. For an entity-specific kind of lending or borrowing, it is at 1%. But for a consumer of lending, the commitment fee is what? Cap. The cap is what? 0.5%. Next, commission charges for underwriting services. Commission charges for underwriting services, negotiable. Now, what are underwriting services? Underwriting services are undertaking made by one of the parties in a syndication, guaranteeing that either a portion of an expected loan will be made available if other parties to that transaction are unable to bring out the whole sum. For example, you are looking for a $2 billion facility. All the banks have assembled to raise $2 billion facility. And it is needed for something that is time-bound, for something that is sensitive, for example. What happens if along the way, 4 banks pull out? Sorry, something came up. We have LC exposure. Our foreign account balances are not okay. We are not able to part with this portion of the dollar. Sorry, we are pulling out. What happens? That the others remaining are raising 80% of the money does not fulfill your purpose as a borrower. What you need is 100%. Getting access to 80% does not meet your need. You need 100%, $20 billion. Therefore, one of the other banks that is a part of the consortium may give an undertaking that we are guaranteeing you. It may even be one of the transaction arranger that if other banks are able to mop up $20 billion, whatever is the shortfall, we are going to make it happen. That's an example of an underwriting service. There are so many other instances of underwriting activity. This is just an example. And I'm trying to tailor it in such a way that it is clearer in the context of what we're discussing. So, but any charges, the amount that will charge you or you have to pay as an institution is what? Is negotiable. We go to the next one. Credit reference reports. Credit reference reports. When a bank is to give a loan to an entity, it does a credit check. For credit check, they go to credit bureau that we have in Nigeria and request for credit history. This is what's this word? BVN of this customer. This is the name, incorporation number. Can you help us do a search? Which other institution is this customer owing? Which other lender is this already owing? Let us have a profile of all exposure of this lender, for example. So that's an example of credit reference report. So how much will be charged? Is the amount incurred in that process. So it's only a cost recovery, right? Only a cost recovery that should be charged. So the bank that is charging you to pay for credit reference report should only recover from you because it incurs to carry out that report. You know, but out of all credit reference reports, you're asking someone, so this man say he's trying to do a domiciliation. You are not asking the other, one of the big companies you used to work with, can you give us a report? Does it normally perform? Does the company normally fulfill its purpose? Does the company normally do everything they should do? Or do they default? You know, you're trying to get a credit reference report. It will be from a search from the credit bureau I just mentioned. The charge for such report, whatever they may be, is only limited to the amount incurred by the financial institution in trying to get that report. Now we'll go to, there's a note on credit reference report. Let me read. This is applicable to only customer-induced reference reports. For loans granted, this cost will be part of the management fee and therefore the customer should not be charged. For credit not granted as a result of negative credit report, full cost recovery should be borne by the customer. So that kind of clarifies it. Clarifies what we just said on that. Interbank borrowing rate. Interbank borrowing rate. This is common between financial institutions. Bank, financial institution. Bank A goes to Bank B, please, you know, lend me 2 million naira for a day. Lend me 80 million naira for 12 hours. Tomorrow I'm going to get it back. We call it overnight or call money. What is the rate? The rate is negotiable. In case you work in treasury, in a bank or in a financial institution, in case you work in credit risk management, in case you work in asset and liability committee of a bank, we should be familiar that banks borrow from other banks to show up temporary liquidity deficit. I use the word temporary, not a systemic, right? Not systemic, not long-term, right? So temporary. So banks, branches, you know, even branches of bank, they swap cash, right, under special arrangements. So that is that. So the rate is all negotiable. Then for tenured, right, overnight, under this interbank borrowing, it will not be overnight. It will be for 1 day, 1 week, 7 days. So we call them tenured. The interest rate are what? Negotiable. That is not about what? Interest rate and lending fees. Interest rate and lending fee. Therefore, where you work currently or where you intend to work, you may hear the owner of the company or the MD complaining that we took a loan of this amount, that all the charges we are seeing, we don't even understand what is happening. We don't understand what is happening at all. So your duty as a financial person, as an accountant, is to pick up, come up with a template. Look at the number of the template I showed us some minutes ago. Look at this template. Come up with a template. Rework it. What is the interest rate? Go and pick the offer letter. The offer letter contains the interest rates at start, contains the management fee, contains the facility enhancement fee, contains any restructuring fee, contains some commitment fee, for example. All of these will be stated in the pricing of that loan in the offer letter. There's a tenor, right? And there are other terms and conditions, like the penal rates when there's default. Pick that offer letter up. One, arm yourself with the content of this guide to charge you by banks and non-bank financial institutions. Pick them. Now open a template like this. Throw in the amounts of loan taken for the tenor. It could be 4 years or 5 years. Throw it in. The interest rate, it could be 30%. Throw it in, right? We've just said for 5 years now. Throw it in. It's going to review what the periodic repayment should be and the component of the principal and the interest that is repayable. Please stay with me. We said for 5 years. What happened if after 1.5 years, 1 year and 6 months, the bank restructured the facility? Stay with me. The bank restructured the facility after 1 year and 6 months. In your review, the first template you developed covered for 5 years, but for 1 year and 6 months down the way, something's changed, right? So for that 1 year and 6 months that is gone, we are going to back it out and come up with a new repayment template containing the restructured amounts and the new terms. When a loan is restructured, a new offer letter is given. A loan restructure letter is given, stating the terms and conditions, stating the restructuring fee, the new tenor of that restructured facility. So use that restructured term, one, armed with your guide to charges by banks and other financial institutions, and prepare a new template starting from 1.5 months into the journey. Forget about the first 1.5 months, 1.5 year, that is gone. The remaining 4 years and 6 months, because you've done 1 year, 6 months, the remaining 4 years and 6 months, do a new template like this. When you do a new template, you can now compare by looking at the bank statement that you have. What are the monthly charges that are dropping? What are the monthly charges that are dropping? All charges, extract them to Excel, and now begin to do the reconciliation. No, this is what they should have charged us, not this. This is what they should have charged us, not this. This is what they should have charged us in month 1, month 2, month 3. Even if they are penal rates are based on installments that are outstanding. And penal rates are not capitalized. I said it before. They are not compounded. You know, penal rate is not used to multiply compounding of periodic default. No. I've said that interest rate will continue to run. If you are to pay, if you are owing 6 million naira, and you're calculating interest rate on 6 million naira, and you're supposed to pay 500,000 and you defaulted, this is the way it works. Penal rates will be used to multiply the 500,000. It is one-off for that, that is gone. If in month 2, you still have not paid that 500,000, penal rate will still be used to multiply that 500,000 for month 2. That is the way penal interest, penalty works, penal expense. What about the interest rates? Let me replay it. Month 1, you failed to pay for your 500,000 and you were owing 600,000 that is valid for the period. The next cycle of interest rate after month 1 will be the interest rate times the 6 million plus that 500,000 that is outstanding. Why? Because you are still holding a further credit. You've given yourself an additional loan. So the interest rate will run not on 6 million now, but on 6 million plus the 500,000. That will run for the next cycle. If in the next cycle, you fail to pay, a customer fails to pay that 500,000, penal rate again will apply on that 500,000. And it will compound in calculating the next cycle of interest rate. That is the way it works. So what we have done, we have gone through these rates for us to know how they work, the meaning, and now to come with our repayment templates and now compare all the debits you see in a bank statement of an entity that has taken a loan. It is very important we take notes. So it's not just so when we see people run training, they say they're doing training, SS bank charges, and you're wondering which is it, you know, the way some of them go about it is not even informed. It's not informed, it's not systematic, it's not orderly in any form, zero, nothing. It's not orderly. So you cannot know you cannot not know. I repeat, you cannot not know the framework for guide to charges by banks and OFIs, that other financial institutions and non-financial institutions. You cannot not know the content of the term of offer letter. And you're talking about bank charges recovery. You are just theorizing. You don't get it. So that is why we need to marry all of this together. The knowledge of the bank charges, of regard to bank charges, one. The offer letter for loan our employer stake in our entity, or even us if we are the owner of the business. And then developing our repayment templates based on the appropriate tenor for 5 years. If along the way there was a restructuring, you have to recompute from that period of restructuring upwards. If there's another restructuring again, you have to compute from that period of restructuring upward, tracking all penal rates charged and how that ought to have been calculated. And also, when a bank has been unilaterally increasing the interest rates without giving you the 10-day business notice, right? Any such unilateral review is invalid. It can be contested because you are not informed. So those are the things. And please, as finance people, as accountants, read offer letter, read it from start to finish. An offer letter will contain the features of the loan amount, tenor, then the price, the management fee, commitment fee, interest rate. Then you're going to see other part. It talk about, other conditions precedent to draw down. What you must do before you can access that loan. All the collateralization, all the documentation, all other things you need to do, we call them condition precedents to draw down. Now, when you've withdrawn the money and you are using it, there's a section of the offer letter that will tell you other conditions, other terms and conditions. Please read them. Read them. It's very key. So that is why we are doing all of this together, so that we can function competently in a real world. Not where we are doing a past question revision so that we can pass ICANN or ANAM. No, not that. We can function competently in a real world. That is the essence of all of this. Let's take note. Now, what we've done is for commercial bank. It's the same thing. I mentioned commercial bank when we started, do you recall? Microfinance bank and mortgage institution. The same philosophy. The same philosophy. But the pricing, right? The rates, are not the same, right? They are not the same in some area. But the same philosophy governs all of that. Now, before I go to that last part, before we take your question and round up. Now, what about this section, a current account maintenance fee? For current account maintenance fee, look at what the guidelines say. Current account maintenance fee applicable to current account only in respect of customer-induced debit transaction to third parties and debit transfers and lodgement to the customer's account in another bank. What you used to call COT, Commission on Turnover, was renamed to account maintenance fee. What you used to call COT, Commission or charges on turnover, was renamed current account maintenance fee. And it is debited to every current account every month. Take note, account maintenance fee does not apply to savings accounts. Account maintenance fee does not apply to savings account. Yes, on a savings account, a customer may be charged card, debit card maintenance fee for the debit card, but the account as a savings account is not subject to account maintenance fee. So this applies only to current accounts. And this is the condition. Current account maintenance fee, CAMF, is applicable to current account only in respect of customer-induced debit transactions to third parties and debit transfers and lodgements to the customer's account in another bank. Note that CAMF is not applicable to savings. Okay, that I've said. Now, this is it. What do we mean by customer-induced debit transaction? When you are the one that writes a check as an account holder, when your company or employer or writes a check as an account holder for payment to other parties, it is called customer-induced. But when a bank debits you for SMS alerts, for example, for account maintenance fee, for example, for VAT on this item, these transactions are called bank-induced transaction. Bank-induced transaction. But the one you incident by yourself, or the company incident is called customer-induced transaction. Therefore, account maintenance fee is charged at a maximum of 1 naira per mil, meaning 1 naira for every 1,000 naira. 1 naira for every 1,000 naira for debit transaction that are incidents or initiated by a customer for payment of third party, one, or for transfer to your account in another bank. Those are the transactions on which account maintenance fee is determined upon. Instruction by your company, your employer, a company, or you yourself to pay third parties or to make transfer to your other account in another bank. So the total amount, right? The total amount, you pay 1 naira per 1,000. If it amounts to 20 million, it's going to be 1 all over 1,000 times 20 million, or 1 naira times 20 million over 1,000. That will become your account maintenance fee for that month. And this applies only to current account. Therefore, when you go to the bank to withdraw for yourself, account maintenance fee under the guideline does not apply to that withdrawal across the counter for yourself. Right? Because you are there to do that transaction by yourself and for yourself. Account maintenance of 1 million, 1 naira per mil does not apply. Take note. So it is when you write a check to third party, you do a transfer to to third party, you do a transfer to your account in another bank. That is where you are charged 1 naira per mil, right, for those debits initiated by you. So that is the way, AMF, account maintenance fee, well, I will say it does not apply to savings accounts. So that is that about that. Now let's quickly go to page 30. And that I'll talk about commission on bonds and all that. It's a little kind of advanced. So we're going to take it in another class, in another session. So let's go to page 30. Let's deal with the one that has to do with microfinance bank. You just see them, the same principle, just different jurisdiction, same principle. So look at for interest rate and lending fee from microfinance bank. That's what we have here. You see interest rate on loan, overdraft, and all of that. The rate is negotiable. Unauthorized overdraft, as we said before, not permissible at all. Drawing against unclear default, negotiable. Micro leasing or microfinance related hire purchase, negotiable. I'm not going to show just as we saw for typical commercial banking or corporate banking. Penal rate, look at it, the same 1% flat per month. Same thing. For the fee, management fee, 1% maximum. Facility enhancement, 1%. Restructuring fee, 0.5%. Right? So that's just to, commitment fee, 1%. Credit reference report, cost recovery. Charges for consortium, the same thing as in commercial bank. Just to bring this also to know, that's why I came here. Now let me go to mortgage bank, and see the interest rates and fees associated with them. I think that was on page 44 on this document. So this is it. Interest rate and lending fee for mortgage bank. Now NHF loan. NHF is National Housing Fund loan. An individual, please take note, when you work for a company that complies with the Federal Mortgage Bank of Nigeria, under the Federal Mortgage Bank of Nigeria Act, that comply with the National Housing Fund provision that says 2% of the base salary should be deducted from the salary and paid to Federal Mortgage Bank of Nigeria. The purpose is at the end of your working life, or when you are ready, you can access additional loan and add to all the contributions that you have made into the National Housing Fund for the purpose of building a befitting house for yourself. That is the purpose, even though it has not achieved that purpose fully. That is the purpose. An employee pays 2% of his or her basic salary through his employer, into the Federal Mortgage Bank of Nigeria, into a national housing fund. After a certain number of years, that employee wishing to build a befitting house can apply to the Federal Mortgage Bank of Nigeria for additional loan to augment his contribution to date to enable the construction acquisition of the house in mind. So what is the interest rate that should be charged by Federal Mortgage Bank of Nigeria? So this is it we are seeing here. The guideline said 6% per annum as prescribed for National Housing Fund loans. No additional interest is allowed. So take note, in case you are the one going to seek a loan from Federal Mortgage Bank of Nigeria, the cap is what? 6%. 6%. That is the cap. 6%. Right? Now, that's the way it works. This 6% on this interest rate is if this loan is fast-tracked, or will I say is incidented, through, how do I put it this way? A lot of government parties or agents are involved in this facility, right? Central Bank of Nigeria, Federal Mortgage Bank of Nigeria, and maybe the real estate company that is enabling a construction. There are so many things involved. But what you should know that the prescribed cap for NHF loan is 6% per annum. Not all this other is based on monetary policy, MPR. No, not that. This is a different kind of thing entirely. Let's take note. For lending for real estate construction, you are lending companies like what's the name of this one? Puan Property, that is covered in VI in Lekki and Aja, Puan Property, or Add-on Homes, or Revolution Plus or something, right? If you are giving loan to such agencies, companies, businesses, those are real estate loan. What is the interest rate? The interest rate is negotiable. Mortgage finance, the same thing, negotiable. Right? That is that for Federal Mortgage Bank related kind of loan and the interest rate associated. For lending fee, those management fee, the same thing, you can see it's 1% here. Facility enhancement fee, 1% here, as you can see. Restructuring fee, 0.5% as before. Penal rate, 1%. Commitment fee, 1%. Credit reference report, cost recovery. Charges of consortium lending, the same as before. So you can see the only area of difference for the mortgage-related loan is on the interest rate on NHF loan, which is 6%. So that is all we have. So in case an accountant, an intending accountant, a young or accountant of little experience, an accounting officer, or a graduate that want to help businesses recover excess bank charges, these are the things you have to arm yourself with. So I want to encourage you and advise you, go to the CBN website and download this guide to charges by banks, non-bank and other financial and non-bank other financial institutions. Download it and study aspects concerning interest and fees, interest rates and fees, whether they're for commercial banks, whether they're for microfinance bank, whether they're from mortgage bank. So in this program, we want to encourage you to get entrepreneurial. Use your financial expertise. Look out for individuals, persons suffering excess or abnormal charges on accounts. Take up the case, write for them, write to CBN Customer Complaints Unit, write to Federal Competition and Consumer Protection Council of Nigeria, write to them, help people seek recovery. It's a way of creating job for yourself while awaiting your NYC or while we are awaiting the gathering of all those expenses you need to work in higher position in a corporate place that you may choose to. So that is why we've shared this. So it's not just for the knowledge, it's not just the ability to work for entities, it's also the ability to work with it to earn income for yourself, through the mastery of these guides, the terms of offer letter given to businesses, and in terms of the content of bank statement of customers, which may have been subjected to excessive charges based on non-compliance to all of the provision of charges contained in this guideline. So we're going to stop here for today and then take a question and contribution before we sign out. Thank you. So you unmute yourself, ask a question, make a contribution as we sign out. So the floor is open. Question, contribution? Question, contribution from anyone here before I sign out? Okay, there's no. I want to thank you for being with us. You know, we started about 11:15 and we are here and we are done, which is on mastering bank charges on bank accounts and transactions. That is what we have gone through, right? And we've not covered other kind of transactions. We're going to take them in phases in the future because we have to do this within the period allotted to this program. And that is what we have done. So thank you for joining us. Thank you, HMD Global, Adebola Abiono, Okoye Grace, there's the name 1, 2, 3, 4, 5, Hope, Olushola, Oluokere, Oluwakemi, that should be okay, madam, Florence, Dele, Obodo, Solomon. Thank you. Also, please go to our YouTube channel and subscribe to, you know, get updates on things like this that I'll be sharing. And we're uploading this recording as soon as we are done with this session. Thank you, everyone. I can say chat. Is there a question? Let me just take note of what is in the chat. Okay, thank you. Those are appreciation. Thank you, thank you, Grace. Okay, bye for now. See you next Saturday as we come up with another title and program as we continue this series. Tell your colleagues, tell your classmates, tell your co-graduates, new accountants, tell your, if you're a parent here who has an accountant, tell your children, your wards, and other people in this category as we go through the practical sessions. Thank you all and bye for now.